Let's begin. Hi, good evening, everyone. My name is Tuya, and I'm from the digital sales team at Saxo Market Singapore, and I'm your host for today's webinar. A warm welcome to everybody, and thank you for taking the time to join us this evening. And we are glad to inform you that the content for today is brought to you by Saxo in collaboration with BNY Mellon. And we have here with us today Aninda Mitra, who is the head of Asia Macro and Investment Strategy for BNY. And today's topic will be about staying nimble in pivotal 2023. So hopefully this can give our audience some ideas and trading inspirations for this year. So, and should you have any questions along the way, do feel free to post them in the chat, and we'll be addressing some of the questions on our Q&A sessions at the end. So before we begin, just a disclaimer. That today's content that we'll be sharing with you is just for your general knowledge and does not include any financial advice. So please only trade or invest once you have read and understood the risk involved in that. So our webinar will take about 30 minutes in total until 7:30, and this will be the agenda for today's session. So I will start off with a short introduction about our Saxo Trader Go platform. And we also do have giveaways for this webinar, which will be giving them away at the end of this session. And our guest speaker, Aninda, will then take over to share with you more on today's main topic, Stay Nimble in a Pivotal 2023, after which we will follow it up with a short Q&A session. And we'll then end off today's webinar with the promo code for you to redeem the free gifts. So do stay tuned till the end. So let us begin with Saxo Trader Go platform. To access the platform, you can go to the URL www.saxotrader.com, or you can just simply log in from our homepage, home.saxo. So Saxo Trader Go is available on both web and mobile app. So let me demonstrate to you how you can build a diversified portfolio through our award-winning platform, Saxo Trader Go. So once you log on to your Saxo Trader platform, this is the main screen layout which you will see. And watch list is the function where you can build your diversified portfolio. And you can select different instruments across different asset classes and add them to your personal watch list to monitor them all together, as you can see on the screen right now. So to create a watch list is quite simple. You can simply click on New and name your watch list. So for example, say you can just type in BNY and save your watch list. And just for example purpose, today's webinar, I've set up a watch list already under BNY webinar. And basically, if there is any instrument that you would like to search for, you can monitor them through, you can find them through Add Instrument here. So for example, BNY Mellon Global, say for example, Global Bond USD. So once you click on it, it will automatically be add to your watch list. Alternatively, you can also find the instrument through the instrument search on the top right corner. So for example, you can type BNY Mellon Global again, and this time maybe you can find it in euros. And then under the product overview, you will see a star icon here. Click on it, add to watch list, and add to your whichever watch list that you would like to add to. Once you click on it, it will be added onto your watch list over here. So it's as simple as that. If you have some time as well, do explore our research tab, because this is where we update regularly with regards to any market research news, as well as any update on the different instrument classes that we have. So that is it for our Saxo Trader Go platform. Moving on to our giveaways. So for this webinar, here's a sneak peek of what you can redeem at the end of the session. So do make sure to stick around with us until the end to retrieve your promo code. So next up, we have our guest speaker, Aninda, who will be sharing with you on today's topic, Stay Nimble in a Pivotal 2023. Over to you, Aninda. Aninda, could you unmute it, please?
There we go. let me just share my screen one more time, yeah?
Could you click on it once again, please?
Yep.
We can see it now.
Okay, all right, perfect. Sorry about the little hold up. Good evening, everyone. Interesting times with lots of action in the equity markets, given the developments we've seen in US banking. We had to change our presentation at the last minute, given the developments since late last week. But our four key messages are up front for you. We are first and foremost suggesting to stay defensive. The reason being, up until middle of last week, there was a notion that there was not going to be a landing in the economy, and we thought a no landing scenario was always unrealistic. Um, it's a delayed landing, perhaps, but there will be a landing eventually. Soft or hard is always up for debate, but a no landing is an open ended and unrealistic theme, which is not a good basis for guiding investment decisions. The second suggestion is that to stay long fixed income. The reason for this is rates have reached restrictive levels, which means we've gotten closer than ever before to the materialization of a recession. What we saw at the end of last week was that something is starting to break more materially in the global financial system. We've seen, bad news about crypto crop up from time to time, bad news about a few select frontier markets crop up from time to time. But for U.S. banks to come under pressure is a more material indication that the rate hikes we've seen, more than 400 basis points of it since November of 2021, is starting to have a bite, and it's not just bark anymore. The third message is that we are quite cautious about equities. At events like this, I keep getting asked, when is it time to go long equities? And I continue to say, not yet. The valuations are still susceptible to corrections. Financial conditions are tight, and real rates are still elevated, and the earnings have begun contracting, and there could be more downside surprises. To sum it all up, a bear market trap is still intact. We'd have to see a peak in inflation or an outright beginning of rate cuts for us to change our view on equities. And the final message is that while we are still, defensively positioned and cautious about equities, we are still attuned to relative returns and cyclical opportunities. Everyone's gotten a bit more excited about European equities. We still think, however, that they're somewhat vulnerable to nonlinear risks from continuing ECB rate hikes. The ECB is probably going to be even more hawkish on a going forward basis than is the Fed. And there's also lingering risks from the Russia-Ukraine conflict, as Europe continues to still depend quite a bit on sources of energy which originate in Russia. Finally, the cyclical opportunity is China. We are suggesting going overweight MSCI China. We do expect to see the only major growth bright spot come out of China, and that's what excites us from a cyclical standpoint. So without any further ado, let me just jump right into it. At the end of last year, when we framed our outlook for 2023, we had cautioned about tough times for risk assets. And what you see on the first fan chart on the left is that rates have indeed peaked. As recession fears continue to intensify, we think now is the time that duration will start to rally more meaningfully. Keep in mind a typical 10-year US Treasury bond pays you about 4% coupon, and with a duration of roughly 7 or 8. And if you expect to see 100 basis points of yield tightening from here in the next 6 to 9 months, that's you can multiply that times the duration to get a rate of return, which easily goes into the low double digits, coupon plus duration returns added together. So that's an area we like. We are still cautious on equities. Our fan chart shows that when you actually have a recession, a soft landing or a hard landing, I mean, it's hard to get back to the peak we saw in early 2022 until either late 2024 or even 2025. So we're equities are, if you must own, we'd suggest staying in defensive sectors. And on the dollar, we saw a steep decline since November of last year, but the dollar sort of firmed again. Our overall view, if you smooth it through policy cycles or policy divergence across ECB, BOJ, and the US Fed, we still think that the rate of depreciation or weakening of the dollar will be very gradual. If anything, is more likely to be stable through most of the rest of this year. So turning to some specific events which have sharpened our view. One is that the inflation problem hasn't gone away. It's still very sticky. You saw the US inflation print from last night. We're still looking at core inflation surprising a little bit to the upside. And at the same time, fear has cropped up in the banking system. And this is the LIBOR minus OIS spread. LIBOR is a bit of an outdated concept now. We should be really looking at forward rate arrangements, but I'm old-fashioned. I still look at this synthetic measure when I get my hands on it. But what that's basically telling you is that LIBOR rates or interbank rates are beginning to creep back up higher than what the overnight index swap rates are telling you. Overnight index swap rates simply pricing in rate cuts in the months ahead, and interbank rate is telling you the extent of counterparty risk there is in the system at short dated tenors. So that spread is beginning to widen out. So there's clearly some lingering fear in the market, even as inflation remains sticky. So that creates a pretty tough backdrop for the Fed. Now markets are pricing in rate cuts. The terminal rates have come off very sharply in both the US as well as in Europe. We think that the pressures in the US are more palpable at the moment. And if anything, the Europeans have an even bigger inflation problem on their hands. So all of this feeds into a backdrop where global financial conditions will continue to tighten. Most of the tightening is really coming from Europe and the US. Japan's financial conditions are quite accommodative. So what that leads up to really is a situation where real rates are going to continue to stay quite high. And this is what we've depicted in the chart on the left. The brown line basically shows you where TIPS yields, where real bond yields are. This is on the right axis, and it's been flipped. So we are currently hovering around 1.5 percentage points. That implies that the PEs on the S&P index should be a little bit lower than where they are. We're still at 17 times earnings on a PE ratio for the S&P. The risk is that it could come off to something around 15 or slightly lower than that even. And the final thing I would point out here is that the earnings cycle is weakening as well. We have a simple model of earnings which looks at the leading relationship of ISM or PMIs in the US, CEO confidence. And what you see is that in the next 6 months at least, earnings will slip below zero and stay below zero for several more months. And with PEs at 17, 18, clearly that's probably not fully priced in. So there's a bit more downside risk to equities, and we're suggesting staying defensive on that front. So where else do we look for cyclical opportunities? One key area is China. What I've tried to show here on the chart on the left is that the long-term PE ratio, the dotted line, is around 14, and we are trending below that level right now at roughly 12 or 13 or so. So even with a modest increase in PE valuations towards long-term average, and if you see a pickup in earnings, which is something I've tried to depict on the chart on the right, where you see nominal growth slow, nominal, not real growth. Nominal growth slowed to around 4% or 5% at the end of last year. We expect that to pick up to around 8% this year. Um, and at very conservatively, if you expect earnings to also rise by around 8%, we're looking at 12 to 15% returns on MSCI China quite easily in the year ahead, and clearly relative outperformance versus most other major global equity indices. So stay tuned to the cyclical opportunities here, whilst being cautious about valuations and earnings in on the S&P. So the final thing I would say is that, whilst we are a bit more constructive across other parts of EM in the local currency space, where EM inflation has not been as awful as developed market inflation, we're still somewhat wary about a reemergence of dollar strength. One reason for that is uh, higher U.S. rates. But if you look at the chart on the left, European inflation for the first time in many years has caught up to where U.S. inflation is. This is the European inflation swaps, 5-year forwards, catching up to where U.S. inflation swaps are, and the difference between the two has basically gone down to zero. What that means is that there's probably, on balance, a bigger chance of the Europeans out hiking the Fed in the months ahead, and that should accord with the weakening trend in the dollar. But in the event you get a hard landing and not a soft landing, that's when the dollar strength comes back. And the final chart on the right just shows you the long-term trend in the dollar versus the movements around it. And even though we've seen a bit of a surge back in the dollar so far this year, our base case is for more of a stable outlook through the remainder of this year, which does create a more constructive backdrop for arguably non-US risk assets. But for now, just be wary of pockets of volatility, especially if the S&P takes a big nosedive or if U.S. growth surprises to the downside. Those are the key reasons why I'm still a bit cautious about any bouts of re-strengthening in the dollar. So let me stop there and see if anybody has any questions or other comments or any other views that we want to discuss. Over to you, Tua.
Thank you, Aninda, for your kind sharings and insights today. So we have got a few questions from the audience, so I'll be just verbalizing a few of them, and maybe you can take some time to address them.
Sure.
So the first question that we have is, do you think the SVB's collapse will make a significant impact for the economy in the long run?
I don't think so. It is a small bank. It's not systemically important. It does expose weaknesses or vulnerabilities at the smaller regional banks with weak risk management, less supervision, and inclination to be somewhat exposed to asset price downturns, especially in the fixed income space. But I think if you take a step back from all this, what we're looking at is a situation where we had gotten so used to low rates and ultra accommodative policies that when you've seen a 400 plus basis point shift higher in rates, people haven't been used to it. When SBV, was investing in fixed income, it was doing so because it had a surplus of cash. It didn't know what to do with it. And fixed income was seen as more of a safe haven, except the valuation hits that they took from being invested in that over the past 1 year is what exposed these problems. So the broader issue here is that higher inflation and higher rates are here to stay, and we'll have to navigate that space on a going forward basis. But I wouldn't go so far as to say that this somehow weakens the long-term prospects of the U.S. economy. Rather, I would suggest that we need a mindset shift. Income is back, uh, inflation's back. These are things we haven't experienced in the last 12 to 15 years since the GFC. So that's the mindset shift rather than any that is required rather than a perception that long-term growth in the U.S. is somehow dented.
Thank you for your response. So we do have another question.
Mhm.
So basically, how is your view on the fixed income markets at the moment?
Well, it's constructive. So the chart on the left again shows you that we have pretty much hit the peak, and as recession fears intensify, now if you look at the dotted line on that chart, it's telling you our median case of a global recession would take down yields to a low 3% handle by the end of this year, and that implies a rally in the fixed income market. And on top of that, you're getting paid a coupon of roughly 4%. So, long story short, we are constructive on fixed income.
Then perhaps just one final question. Do you
Mhm.
see any opportunities in the emerging markets? And if yes, which sector can investors look into?
So we are cautiously optimistic in the local rate space, and the reason for our optimism is that inflation in many large investment grade rated economies has peaked, and they've actually not been as high as what it's been in reserve currency issuing developed markets. So with that peak in major EMs, peak in inflation in major EMs, there's not a need to continue hiking rates from here. They could even cut rates from here. So that's what drives our constructiveness, our constructive view on EM local currency. The reason I said we are cautiously constructive is because there's still going to be pockets of dollar strength. So, if you do get a hard landing in the U.S. or if you do get a very sharp downshift in the S&P, then there would be some spillovers onto EM exchange rates as well. So that's why I'm saying we're cautious, but we're also constructive on EM local rates.
Right. Thank you so much for responding. So,
Mhm.
in the interest of time, I think we will be addressing all the other questions that we have via the emails that the viewers have registered for their webinars today.
Okay.
So we'll just move back to the slides.
All right.
Yep. So for those who would like to rewatch the webinar, it will also be uploaded on our webpage 3 days from now as well. Yep. Basically, if you scan this QR code, you'll also be able to sign up for our upcoming webinars. Yep. And here is the promo code. So all you have to do is to email us at ps@saxomarkets.com with the promo code, and you will walk away with the free gifts from BNY, which you can collect from our Saxo's new office, along with the $20 commission credit from Saxo as well. And of course, for those who are rewatching this, you can also follow us on our social media and subscribe to our YouTube channel, Saxo Market Singapore, and you will also stand a chance to win some of the door gifts as well. And if you have any sales inquiries or any feedbacks regarding this webinar tonight, please also drop us a note via the feedback form when the session ends, or just drop us an email at ps@saxomarkets.com as well. And if that is all, then thank you, Aninda, for conducting the webinar today with us. And a big thank you to the audience as well for their kind participation. And we hope that you have enjoyed today's webinar as well. And last but not least, if you do not have if you do not have a Saxo trading account yet and would like to open one with us, do visit our homepage, home.saxo. It takes less than 10 minutes to complete the application form online via MyInfo SingPass. Once again, thank you everyone for joining us today and have a good night.
Bye now.
Bye.